Welcome back to Boni's Life, the channel where we dissect the digital economy with a clarity you won't find anywhere else. We are in the final stretch of 2025, a year that has redefined the very fabric of our financial world. Today, we rewind the clock, embarking on a deep forensic analysis of a month that was a crucible for the crypto markets, March 2025. It was a month of paradoxes, a period of intense volatility and fear, yet simultaneously a time of monumental policy shifts and institutional conviction. Forget the headlines and the noise. We are going deeper, uncovering the hidden mechanics that truly moved the markets. By the end of this episode, you will not only understand what happened, but why it happened and what it signals for the future. Let's set the stage. March 2025 was not for the faint of heart. The global cryptocurrency market cap, a barometer for the health of our entire industry, ended the month at approximately $2.9 trillion, a dip of over 2%. Bitcoin's dominance stood firm at a commanding 59.1%, while Ethereum held 11.7% of the market. But these numbers only tell a fraction of the story. The prevailing sentiment, as measured by the Crypto Fear and Greed Index, was one of extreme fear, plummeting to a score of 25 out of 100. This level of fear is a breeding ground for volatility, and March delivered in spades. Bitcoin's 30-day average volatility surged to 72%, a level not seen since August of 2024. Ethereum was even more tempestuous, with its volatility hitting 95%. For those invested in assets like Solana, the ride was wilder still, with volatility reaching a staggering 137%. The price action was a tale of two halves. The month began with a surge of optimism, a carryover from February's bullish momentum. In the first week, Bitcoin leapt 9%, briefly touching the $93,000 mark, while Ethereum climbed 11% to reclaim $2,500. But this rally was short-lived. The market then entered a prolonged consolidation phase, with Bitcoin trading within a tight range of $80,000 to $88,000. By the time the dust settled on March 31st, Bitcoin had closed at $82,548.91, a modest 2.2% loss for the month. Ethereum, however, bore the brunt of the market's anxiety, closing at $1,823.48, a painful 22% decline. So the critical question is, what were the powerful undercurrents causing these seismic shifts? The answer lies in the complex interplay between macroeconomic forces and groundbreaking regulatory developments. To understand much, you must first understand the global economic chessboard. The Federal Reserve, the world's most powerful central bank, held its key interest rate steady in a range of 4.25% to 4.5% during its March meeting. While this was expected, the real bombshell was the Fed's announcement regarding quantitative tightening, or QT. They declared a significant reduction in the pace of QT, from rolling off $25 billion a month from their balance sheet to just $5 billion starting in April. In simple terms, the Fed was signaling a pivot from a restrictive monetary policy to a more accommodative stance. This is rocket fuel for risk assets like cryptocurrencies. More liquidity in the system means more capital looking for a home, and historically, a significant portion of that capital finds its way into our digital asset ecosystems. Compounding this effect was the pronounced weakness in the US dollar. The dollar index, or DXY, which measures the dollar's strength against a basket of other major currencies, tumbled to a 4-month low. A weaker dollar has a direct inverse correlation with Bitcoin's price. As the world's reserve currency loses value, assets like Bitcoin, which are often seen as a global non-sovereign alternative, become more attractive. This isn't just theory. It's a dynamic we've seen play out time and time again. This confluence of increased global liquidity, evidenced by the rising M2 money supply and a depreciating dollar, created a powerful tailwind for crypto. However, this bullish setup was met with a formidable headwind: the health of the US economy itself. The aggressive interest rate hikes of the past few years were finally beginning to bite. Forecasts for US GDP growth in the first quarter of 2025 were revised downwards to 2.3%. The Nasdaq, a proxy for the tech sector and often a leading indicator for crypto, had already entered a technical correction, falling 13% from its mid-February high. Add to this the cloud of uncertainty created by the Trump administration's ongoing tariff negotiations, and you have a classic risk-off environment. This is why we saw the correlation between Bitcoin and the Nasdaq spike from a low of 0.19 at the start of March to 0.60 by the end of the month. When traditional markets sneeze, crypto often catches a cold. This tug-of-war between bullish monetary policy and bearish economic growth was the defining narrative of March. But while the macroeconomic picture was a mixed bag, the regulatory landscape in March was an unambiguous, resounding victory for the crypto industry. The most significant development came directly from the White House. President Donald Trump signed a landmark executive order to establish a U.S. strategic Bitcoin reserve. This is a monumental step. It means the United States government will not be selling its stockpile of approximately 200,000 seized Bitcoins. Instead, it will hold them as a strategic asset, with the potential to acquire more through budget-neutral means. This act alone provides a powerful, long-term validation of Bitcoin as a legitimate store of value on the world stage. It's a signal that the US intends to be a leader, not a laggard, in this new digital economy. The good news didn't stop there. In a stunning reversal, the Securities and Exchange Commission, SEC, announced it was dropping its long-running contentious lawsuit against Ripple. For years, this lawsuit has cast a long shadow over the entire altcoin market, creating regulatory uncertainty and stifling innovation. The dismissal of this case was a watershed moment. The price of XRP surged on the news, but the implications are far broader. It provides a degree of clarity for other crypto projects and signals a potential shift in the SEC's approach from regulation by enforcement to a more constructive dialogue. This single event has unlocked a tremendous amount of potential for the industry. And the victories kept coming. The FDIC rescinded its requirement for banks to get prior approval for crypto-related activities, lowering the barrier to entry for traditional financial institutions. The US Senate voted to repeal the IRS's expanded and burdensome crypto broker rule, a huge win for the DeFi sector. The Treasury lifted its sanctions on Tornado Cash, a privacy protocol. Criminal suits against projects like Hex and Kraken were dismissed. This wasn't just a series of isolated events. It was a coordinated, systemic shift towards a more favorable and clear regulatory framework in the United States. This is the kind of progress that lays the foundation for the next wave of mass adoption. While retail investors were gripped by fear, the smart money, the institutional players, were quietly accumulating. They saw the bigger picture. Michael Saylor's MicroStrategy, a longtime Bitcoin evangelist, added another 29,000 BTC to its treasury during the March dip. But it wasn't just the usual suspects. We saw new, unexpected players enter the game. GameStop, the video game retailer that became the face of the meme stock phenomenon, announced it had sold a $1.3 billion convertible bond with the explicit intention of allocating the proceeds to Bitcoin. This is a powerful signal of Bitcoin's growing appeal as a corporate treasury asset. Even US-listed Bitcoin ETFs were net buyers, scooping up another 246 BTC. The institutions were not deterred by the volatility. They were capitalizing on it. Now let's put on our trader hats and look at the technicals. The consolidation of Bitcoin between $80,000 and $90,000 was the third such phase in this bull market. These periods of sideways movement are healthy and necessary. They shake out weak hands, allow for the market to build a solid support base, and prepare for the next leg up. However, a concerning sign was the collapse in spot trading volumes. According to data from CoinGlass, spot volumes fell to a 6-month low of just $1.34 trillion for the month. That's a 55% drop from the peak in January. Low volume in a consolidating market can be a sign of indecision and can sometimes precede a sharp move in either direction. And that brings us to liquidations. For those who are new, a liquidation is when a leveraged position is automatically closed by an exchange because the trader no longer has sufficient funds to cover their losses. In March, we saw several massive liquidation events, particularly during the sharp price drops. On some days, hundreds of millions of dollars in long positions were wiped out in a matter of hours. This is a brutal but essential part of the market cycle. It flushes out excessive leverage and resets market sentiment, Watching the liquidation data on CoinGlass during March was like watching a high-stakes poker game where the over-leveraged players were being systematically removed from the table. So, what does this all mean for you, the investor? Let's run a simple yet powerful thought experiment. Imagine you had invested $100 at the beginning of March. If you had put that $100 into Bitcoin, by the end of the month, your position would have been worth approximately $97.20, a loss of about 2.8%, a small setback. However, if you had invested that same $100 into Ethereum, your position would have shrunk to just $77.60, a significant loss of 22.4%. This stark difference in performance highlights a key theme of March: Bitcoin's resilience. In times of uncertainty, capital tends to fly to safety, and in the crypto world, Bitcoin is the ultimate safe haven asset. March 2025 was a microcosm of the entire crypto journey. It was a month of fear and conviction, of macroeconomic headwinds and regulatory tailwinds, of institutional accumulation and retail capitulation. It taught us that while the market can be volatile and unpredictable in the short term, the long-term fundamentals have never been stronger. The establishment of a US strategic Bitcoin reserve and the clearing of the regulatory fog are not just temporary boosts. They are foundational pillars for the future of this industry. The institutions are here and they are not leaving. The path forward will not be a straight line, but for those who can see through the noise and understand the powerful forces at play, the future is brighter than ever. Thank you for joining me on this deep dive. Don't forget to like, subscribe, and hit that notification bell so you don't miss our next episode where we will be dissecting the month of April. This is Boni's Life, signing off.